Hello everyone, in today's session we are going to discuss one of the most vital theorems that we have in the bond principles or in the bond theorems, that we call it as the volatility principle, which means we are going to understand how much the bond is volatile or how much the markets in the bonds is volatile to the market interest rates. Now, to understand this principle, again let us take up one problem. Say for example, we are going to start off with, say, there are 3 years that we have, year 1, 2 and 3. Now we know the moment we are understanding the volatility principle, let us take an example of, say, the market interest rates. We know that there is a direct relationship between the market rates with the bond principles or with the bond prices. So let us assume that the market rates for the first year it is 20%, for the second year it is 25%, and for the third year it is 30%. Now, so how much is the change that has happened in the market interest rates? So let us write down the changes that has happened in the market interest rates. So for the first year that we have, there is no change over here. As it is 20%. For the second year, as we can see, from 20% it has become 25%. So there has been an increase by 5%. That is, there is a positive change by 5%. Now what has happened in the third year? If we compare with the second and the third year, again there has been a further increase by 5% when we are comparing the third year with that of the previous year, that is the second year. Now, if I try to understand the change that has happened for my third year in comparison to the first year, so we can see from the first year there has been an increase. From the first year to the third year, the interest rates in the market has gone up by 10%. Now, what do we understand by the term volatility principle is, when there is a change in the market interest rates, how that is going to impact on the market prices. And it is directly going to impact my bond prices that we have already understood in the sensitivity principle, how it is going to react to it. Now, coming to the volatility principle, we already know that a change in the market interest rates will impact the bond prices for this current problem. Now, say for example, if we write the bond prices over here, and say for the first year the value of the bond was rupees 100, and the change in the interest rate by 5% increase for the second year, how that is going to impact my bond prices. We know that the bond prices is going to fall over here with the basic concept that when there is a positive increase in the market interest rates, there has to be a downside movement in the bond prices exceeding 5% over here. Say, let us assume that the bond prices decreases by say 7%, and one thing that we have to understand, the decrease should happen to a minimum of 5%, and exceeding 5% decrease has to happen where we have assumed that the decrease was 7%. Now, if we assume that there is a decrease of 7% on rupees 1000, so how much becomes the bond price at the second year? It becomes somewhere around 930 rupees. Now, what should happen in my third year? That is very, very important. It is further going to decrease because for the third year the market interest rates has further increased by 5%. So the bond price has to further decrease over here. Now the decrease is dependent on the market interest rates that we have already understood in the sensitivity principle. Now, how volatility principle is different from the sensitivity principle is, in the volatility principle, one more factor that we include over here to determine about the bond prices is the coupon rates. Now, this column is the addition that we have in the volatility principle. So what does the volatility principle say to us? The decrease in my third year is supposed to happen how much? Now, how much it is going to happen? What is the minimum decrease that it should happen in the bond price? As we know, from the first year till my third year, the increase in the interest rates happened by 10%. So the decrease in the bond price should happen at a minimum of 10% over here. Now, if I assume that by the same rates it should decrease, and we have already studied the other bond principles where it says it has to happen at a diminishing rate. That means it cannot happen at 14% over here. It should happen somewhere around 13.5%. The rates are going to decrease. There has to be a fall in the bond price. The fall is going to happen not at the exact rates of decrease, but at a slight diminishing rate it is going to happen. Now, as per the volatility principle that we have, the decrease can be further slowed down. I want to decrease. It is all about the protection of the bond prices or the protection of the volatility that we call it in the volatility principle, where we try to restrict the fall in the bond prices. Now, with the help of the coupon rate, and if the coupon rates are high, say for example, for all the 3 years, if we assume that the coupon rates is at 20%, we can slow down the decrease of the bond prices, which means my third year will not see a decrease at 13.5%. Say the decrease we can see somewhere around 12%. Which means that the bond price decrease in value from 930 rupees, and we have tried to slow down the value of the bond prices decrease over here, which was supposed to decrease at 14% over here, and under the normal circumstances it will diminish the moment you increase the maturity period, and it has diminished to 13.5%. We are trying to further reduce or slow down in the process of the bond price decrease, and with the rates of coupon rate which is higher over here, my bond value decrease can be restricted at 12%, and let us assume that the bond price will close at rupees somewhere around 880 rupees with a 12% decrease over here. So with the volatility principle we can conclude that if the coupon rates are high over here, we can see that the coupon rates are high at somewhere around 20%. The fall in the prices of the bonds over here, the fall in the prices, we can see that the bond prices has fallen from 1000 rupees to 930 and from 930 to 880 rupees. We can restrict the fall in the prices of the bond at a much slower rate, provided the coupon rates are high over here. With this, we think, okay, that the volatility principle is clear to us. With this, we conclude the session. Thank you.